Hello everyone, you're very welcome back to the channel. Today we're going to be talking about claiming a UK state pension from Ireland. There are many Irish people who have previously worked in the UK. Likewise, there are many Irish people currently working in the UK, and there are many Irish people anticipating a move to the UK in the near future. When an Irish person takes up employment in the UK, that person starts paying national insurance contributions to Her Majesty's Revenue and Customs, or the HMRC. This is the equivalent of an individual in Irish employment paying PRSI to revenue. The payment of national insurance contributions while in the UK counts towards an entitlement to a UK state pension. Hence why it's possible for an individual who previously worked in the UK to claim a UK state pension from Ireland. Unsurprisingly, there are quite a few ifs and buts associated with claiming a UK state pension from Ireland, and it's very easy to get bogged down in the details. But fear not, I'm going to explain everything that you need to know in plain English. By the end of the video, you'll know whether you qualify for the UK state pension, how you can improve your UK state pension, why the UK state pension is so valuable, the important dates for deadlines, initial steps to secure your UK state pension, and much more. All sections of this video will be timestamped for your convenience. Let's start off by talking about how an individual qualifies for the UK state pension. In order to qualify for the minimum UK state pension, an individual must have 10 qualifying years on their UK national insurance record. That begs the question, what is a qualifying year? A qualifying year is a year where you either A, earned more than the primary threshold in the UK, which is currently £12,584, and you paid national insurance contributions, or B, you earned less than the primary threshold but more than the lower threshold, which is currently £6,396, and you were credited with national insurance contributions. Fortunately, you don't have to work out how many qualifying years you have on your record, because HMRC will do this for you. The value of the UK's new state pension is £185.15 per week, which is £9,627.80 per year. You need 35 qualifying years on your national insurance record in order to be entitled to the full UK state pension of £185.15 per week. So the minimum of 10 qualifying years would buy you a UK state pension equal to £52.90 per week, or £2,750.80 per year. The most important thing to note here is that you need to have 10 qualifying years on your UK national insurance record to receive a UK state pension, and the value of that pension will be a fraction of the full state pension. The more qualifying years you have, the more state pension you get. For individuals who worked in the UK for long periods of time, 10 qualifying years isn't an issue. But what about individuals who spend less than 10 years working in the UK before returning to Ireland? Is all hope lost for a UK state pension? No, it's not. When you move back to Ireland and stop paying UK national insurance contributions, the UK government views this period as a gap in your national insurance record. In fact, living and working outside of the UK is listed as one of the primary causes of gaps in one's national insurance record. These gaps can potentially cause issues for the likes of UK citizens who spend many years working abroad. Why? Because their lack of national insurance contributions, and therefore their lack of qualifying years, may prevent them from claiming the full UK state pension in retirement. To prevent this from happening, the UK government allows voluntary national insurance contributions to be made. The purpose of these voluntary contributions is to fill gaps in one's national insurance record. In other words, voluntary contributions are used to purchase qualifying years. These voluntary contributions allow Irish people who previously worked in the UK to achieve two things. Number one, it allows them to obtain 10 qualifying years on their national insurance record even when they spent less than 10 years working in the UK. And number two, it allows them to increase the value of the UK state pension that they receive all the way up to the full UK state pension if they so desire. Now, normally the UK government only allows you to make voluntary national insurance contributions to fill gaps in your national insurance record when those gaps have arisen over the past 6 years. We're currently in 2023, meaning that under the UK government's rules, you'd normally only be able to fill gaps in your record between 2017 and 2023. Put simply, you can only purchase a maximum of 6 qualifying years in one go, and those 6 years are the 6 years preceding the current year. Once you've exhausted exhausted those 6 years, your only option is to buy one qualifying year at a time as needed. However, until July 31st, 2023, the UK government is allowing voluntary national insurance contributions to be made to account for gaps in national insurance records arising between April 2006 and April 2016. In other words, until July 31st, 2023, you can buy up to 16 qualifying years in one go. This can allow an individual with less than 10 qualifying years on their record to qualify for not only the minimum UK state pension, but a UK state pension of a decent size. After July 31st, 2023, the rules will revert back to a maximum of 6 years. So if you want to add up to 16 qualifying years to your national insurance record, you need to act fast. This is especially true for individuals who are close to the state pension age of 66. That's because you want to be entitled to as much of a UK state pension as possible as soon as you hit age 66. But if you don't take advantage of the additional 10 years worth of voluntary contributions that are being offered until July 31st, you're running the risk of not only having a lower UK state pension entitlement, but potentially no entitlement at all. The closer you are to age 66, the greater that risk becomes. Even if you're in your 30s, 40s, or 50s back working in Ireland, it's still advisable to take advantage of these additional years, get them onto your national insurance record, and secure your UK state pension. There are some conditions that you need to meet in order to be able to make voluntary national insurance contributions. The exact conditions that apply will depend on whether you're making Class 2 or Class 3 voluntary contributions. For individuals who are living and working in Ireland, there is no real difference between making Class 2 and Class 3 voluntary contributions in terms of the benefits that you'll receive. Both classes will provide you with an entitlement to the UK state pension. However, there is a big difference between the price of Class 2 contributions and the price of Class 3 contributions. We'll talk more about that in the next section. In order to make Class 2 voluntary contributions, the following conditions must apply. A, you must have worked in the UK immediately before leaving, and B, you must have lived in the UK for 3 years in a row, or C, you must have paid 3 years worth of national insurance contributions. It's really important to be aware that many websites online are suggesting that as an Irish person, you won't be entitled to make voluntary contributions unless you've paid at least 3 years worth of national insurance contributions already. But this isn't true. Provided you lived in the UK for 3 years in a row and you were working in the UK immediately prior to leaving, then you should qualify for Class 2. The errors on these websites likely stem from the fact that HMRC themselves had incorrect guidance on their website for nearly 18 months. That guidance suggested that you would need to have paid 3 years worth of national insurance contributions in addition to having lived in the UK for 3 years in a row. In order to make Class 3 voluntary contributions, the following conditions must apply. A, you must have lived in the UK for 3 years in a row, or B, you must have paid 3 years worth of national insurance contributions. If you're currently working in Ireland and are eligible to make both Class 2 and Class 3 contributions, you can choose either, but as you'll see in a second, you should always choose Class 2 over Class 3. If you've reached the state pension age already and are looking to fill gaps in your national insurance record, you can only make Class 3 contributions. That begs the question, how much does it cost to make Class 2 and Class 3 voluntary contributions? The current rates for Class 2 and Class 3 are £3.15 per week and £15.85 per week respectively. Therefore, purchasing one qualifying year for your national insurance record at the current rates for Class 2 and Class 3 would cost £163.80 and £824.20 respectively. As you can see, Class 2 contributions are 80% cheaper than Class 3 contributions. However, both sets of contributions count equally towards your UK state pension entitlement. So there's no reason why you would pay Class 3 contributions when you could pay Class 2. The prices of Class 2 and Class 3 contributions change over time. When you're making Class 2 contributions, the price you pay to fill a gap in a prior period is always the current year price for all years except the previous year. When you're filling a gap in the previous year, you pay the Class 2 price for that year. Likewise, when you're making Class 3 contributions, the price you pay is always the current year price for all years except the last 2 years. From the 1st of August 2023, the cost of Class Class 2 voluntary contributions is going to increase from £3.15 to £3.45, which is an increase of 9.52%. The cost of Class 3 voluntary contributions is going to increase from £15.85 to £17.45, an increase of 10%. This means that the cost of purchasing one qualifying year for your national insurance record from the 1st of August 2023 will be £179.40 under Class 2 and £907.40 under Class 3. So, by taking action before July 31st, 2023, not only are you securing up to 16 qualifying years for your record, but you're also saving around 10% on the cost of those years, and that's before you consider any future price increases. If you think about it logically, if you have the ability to buy 16 qualifying years today at the Class 2 rate, why wouldn't you do so? If you're close to the state pension age, by purchasing at today's Class 2 rate, you're reducing or totally eliminating the amount of years that you'll need to buy at the Class 3 rate in retirement to get the same desired benefit. Even if you're far from retirement, by purchasing at today's Class 2 rate, you're reducing or totally eliminating the amount of years that you'll need to buy at higher Class 2 or Class 3 rates in the future to get the same desired benefit. So, is it worth it? Does it make sense to pay £163.80 or even as much as £824.20 for every additional qualifying year on your record? If you wanted to purchase, say, 15 years, that would cost you £2,457 at Class 2 and £12,363 at Class 3. That's a significant chunk of change, with Class 3 representing a much larger financial commitment. Let's take a look at the numbers by using an example. Let's say that you qualify for Class 2 voluntary contributions and that you have 4 qualifying years on your national insurance record already. You then purchase 12 additional years before July 31st, 2023 via voluntary contributions, which brings your total number of qualifying years to 16. This comes at a cost of £1,965.60. Because you now have more than 10 qualifying years on your record, you're entitled to the UK state pension. Your entitlement is calculated as the full UK state pension, £185.15 per week, multiplied by the number of qualifying years, in this case 16, and divided by 35, which is the number of years needed to obtain the full UK state pension. That gives you a UK state pension entitlement of £84.64 per week, or £4,401.28 per year. That's £4,401.28 every year until you die. You paid £1,965.60 and you're getting £4,401.28 every single year in return. That's an absolute no-brainer. In fact, it takes you less than 6 months to break even on your investment before tax. Everything after that is pure profit. Making Class 2 voluntary contributions, where available, is arguably the best possible use of your savings. What if you were to purchase the additional 12 qualifying years with Class 3 contributions? Same as before, your UK state pension entitlement will be £4,401.28 per year. However, this time you're paying £9,890.40. Even at the higher cost, it would only take you just over 2 years to break even on your investment before tax. In other words, if you plan on living beyond age 68, then this is a no-brainer, even with Class 3 contributions. The value of each additional qualifying year can be neatly summarized as follows. Each additional year purchased with voluntary contributions will add £275.08 to your annual UK state pension. That's £275.08 every year until you die. So if you live for 25 years in retirement, each additional year on your record would be worth £6,877, and that's before you consider any increases in the UK state pension during that period. At the current rates, each year will cost you £163.80 with Class 2 contributions, giving a break-even period of 7 months before tax. With Class 3 contributions, it will cost you £824.20, giving a break-even period of 3 years before tax. No matter what way you look at it, if you intend on living well into your 70s and beyond, which most of us do, then voluntary contributions are a no-brainer. A great way of visualizing the sheer value of this deal is to compare the cost of purchasing one additional year on your national insurance record to the cost of purchasing an annuity that provides £275.08 per annum. If we assume an annuity rate of 4%, you'd need to pay £6,877 in order to purchase a guaranteed income for life of £275.08. If we assume that annuity rates will normalise back to around 3% in the future, it would cost you £9,169. Compare that to the £163.80 that you're paying at Class 2 and the £824.20 that you're paying at Class 3. I can't emphasize enough just how valuable this deal is. Once again, it's a no-brainer. One of the biggest benefits of the UK state pension is that it's subject to triple lock provisions. The triple lock provisions seek to ensure that the UK state pension increases in value every year by the higher of the following amounts: A, 2.5%, B, the increase in the average rate of earnings, and C, the rate of inflation as measured by the Consumer Price Index. As you can see, the UK state pension has increased in value by at least 2.5% every year since 2011. Bear in mind that the Irish government offers no equivalent to the triple lock provisions for the Irish state pension. So you're not just buying a UK state pension, you're buying an entitlement to an inflation protected, government guaranteed income stream for life, and you're doing so at a fraction of the price of open market annuities. At this stage, you might be asking, what's the catch? Because all of this sounds too good to be true. Surprisingly, there isn't one. While there isn't a catch per se, there are certainly additional factors that need to be taken on board. Firstly, income you receive from the UK state pension is going to be liable to Irish tax, provided you're Irish tax resident and domiciled in Ireland. The more tax you pay, the longer it's going to take to break even on your voluntary contributions. However, even with tax, voluntary contributions are still a no-brainer. Secondly, you need to consider whether or not you're going to return to the UK to work in the future. This is especially true for younger workers. The reason why this is relevant is because if you purchase qualifying years via voluntary contributions and you then subsequently return to the UK to work, you might end up receiving the full UK state pension through working alone. In that case, the years that you purchased would go to waste. So it's a question of either purchasing the bulk of the years now at today's price and locking in your benefit at the risk of subsequently returning to the UK for an extended period of time, or purchasing some or no additional years now at the risk of not returning to the UK and having to purchase those years at a later date and at a higher price. The additional caveat being the ability to only purchase a maximum of 6 years in the future as compared to 16 today. If you've no intention to return to the UK for work in the future, then this doesn't concern you. So with all of that being said, what are the steps that you need to take in order to secure your UK state pension? The first thing you should do is check your national insurance record, which can be done via gov.uk. I'll leave a link to this site in the video description. This will tell you if you can pay voluntary contributions to fill in gaps in your national insurance record and how much those contributions will cost. In order to access the site, you need a government gateway user ID and a password. If you don't have one, you can create one. The second thing you need to do is fill in form CF83, application to pay national insurance contributions abroad. Again, I'll leave a link to this form in the video description. You'll be required to provide details about yourself, the nature of your absence from the UK, your employment, your bank account, whether you're applying for Class 2 or Class 3 contributions, and how you wish to pay. For Section 25, do you want to know about any shortfall of national insurance contributions that you can pay? Make sure you tick yes. By doing so, HMRC will notify you of any gaps in your national insurance record, and you can choose whether or not you want to fill those gaps with voluntary contributions. You then need to return the completed form to HMRC in the UK. It is crucially important that you get this letter sent off ASAP. HMRC is experiencing a huge surge in customer requests, hence why the deadline has been extended from April 2023 to July 2023. The sooner you get this letter sent off, the more likely it is that HMRC will get back to you before the deadline. As for payment, if you're paying for Class 2 contributions, you can pay online using your online banking details and the 18-digit reference number shown on your HMRC payment request. This reference number is entered onto this webpage where you'll subsequently be prompted to pay via bank account. If you're paying for Class 3 contributions, you can pay online in a similar fashion. You'll need to enter your 18-digit reference number, which you'll find on your bill. Once you've paid your contributions, you'll then receive a notice each year from the HMRC for the tax year just gone. Essentially, the HMRC is notifying you of the amount that would need to be paid if you wanted to add the prior tax year just gone to your national insurance record. There is no obligation to pay contributions beyond what you initially specified to HMRC. Finally, there are support services who you can contact if you're unsure as to whether or not you should pay voluntary contributions. I'll leave these linked in the video description, but as we've shown, voluntary contributions are a no-brainer. The only circumstance where this might not be the case is where you have an individual who is already well past the state pension age. In conclusion, voluntary national insurance contributions are 100% worthwhile if they're available to you. Class 2 contributions in particular represent insane value for money, but Class 3 is no joke either. You need to take action today in order to fully avail of what could be 16 additional years on your national insurance record. That option expires on July 31st, 2023. Once you have filled in the gaps in your national insurance record, the journey doesn't stop there. You can continue to add 1 year to your record at the end of each and every tax year, slowly working towards that full UK state pension entitlement. If done correctly, you could be in a situation where you're receiving both the full Irish and UK state pensions in retirement. Let me know if you have any questions on anything that we've covered in this video. If you found this video to be useful, can I ask that you take just 2 seconds out of your day to show your support by leaving a like and subscribing to the channel. Don't forget to spread the word by sharing this video with family and friends who might be eligible to claim a UK state pension. Before you go, you might be interested in this next video, which talks about the best savings account for Irish savers in 2023. Thanks very much for watching, and I'll see you soon.